Hi, this is Harish here with Rootvij, Mahesh, and Raghav, and we welcome you to the 5th episode of the Dogs of the Law Street Options.
We call ourselves the Dogs because we look out for your investment efforts and we are loyal to our listeners.
And contrary to the name, which is just a nod to the Wall Street of our home country, India, we will mostly be discussing American markets on this show.
We will be your best friends when it comes to investing during a pandemic, and we're here to help you learn the basics of finance, capital markets, and applied economics.
So, to introduce derivatives again, since this is the second part of the derivative series, derivatives are just contracts that derive their value from an underlying asset. So, an options contract, which is the topic for today, is an agreement between a buyer and a seller that gives the buyer of the options contract the right to either purchase or sell a particular asset on an expiration date at a fixed strike price. So, options can be used in over-the-counter markets for real estate and commodities, but today we'll cover the type of option that has the most usage: exchange-traded option. And again, options can be used as a contract for real estate or for commodities, but like we said, that's unregulated, and it still follows some of the concepts that we're discussing today, but a lot of the stuff that Mahesh will be discussing, like the Greeks and some of the technicals that comes to options, that'll be based on exchange-traded options. So there are two types of options: a call option, which is the right to buy, and a put option, the right to sell. Options are called options because they give you a choice. You can choose to exercise and buy at the predetermined price, or you can choose not to exercise it. Because of this, you require no margin to purchase and trade options. Your losses are limited to whatever premium you paid to buy the option. Now, based on the word premium, it should be obvious to you that the options contract is a form of insurance, and insurance can make you very profitable because you can collect premium by selling options, or you can limit your downside by buying options as a hedge against future market fluctuation. Now, this sounds similar to futures, and it is in one sense, but the thing that's better about options is that most ordinary investors can purchase them without any sort of margin requirements. So you're not committed to buy something in the same way you are with a forward contract, and this makes them far less riskier for retail investors. When it comes to exchange-traded options, you can buy a put or call contract on any stock that has option writers, people who are selling them. You cannot write an option unless you have extensive capital, so a lot of options are sold by institutions like banks. Just a fun fact, the concept of options as an insurance policy have been dated to the 1600s in Holland, although the overarching concept of options themselves have existed in even the most ancient economies. So how would you use options? Just a small example would be, let's say that you believe in 1 year 100 shares of X stock that, and X is actually US Steel, so let's say it's US Steel. So let's say that you believe in 1 year the 100 shares of X stock that you own may not be stable. Then you could sell a put option on your 100 shares, which is a covered put for a strike price of your preference. Sorry, not sell a put option, buy a put option on your 100 share. So like we said earlier, a put option is the right to sell, right? So now you're buying the right to sell for a strike price that you decide. So let's say you buy a put option for $1 less than the current price of the share. Then in 1 year, if you're expecting a recession and let's say the stock crashes $4, then you only sell it. Then you could sell it for $3 above what it's currently trading at. So that way, you're securing your gains. This will guarantee that in 1 year, if your shares prices fall below the strike, you'll be able to sell for the strike price that you chose. So this helps you sort of adjust for risk, and now you know what price that you can be at least selling it at. This helps you financially plan. And again, you can see how this would be useful for businesses and banks, right? So imagine that you're a bank and you own millions of shares, right? Because you're, let's say, underwriting or you're doing an IPO. You own so many shares, right? It would be great to have options on those shares because if you're either selling options or buying options in order to hedge against market fluctuations, now, whoever is working with your bank or whoever's invested in your bank is a lot safer. And it's the same deal with a hedge fund or a wealth management fund or even exchange traded funds and mutual funds. All of these managers, pension managers, they need to use options or else the large amounts of money that they're handling will not be safe. So there's plenty of option strategies that you can use to hedge to whatever effectiveness that you want to. And and this would just be, one way would be buying puts. That would be one way to issue your shares against any drastic movements like a recession. You could also, go ahead, man.
Sorry, just one thing I wanted to clarify is that options usually control 100 shares. That's not always the case, but especially for exchange traded options, options that control a stock as their underlying asset, they control 100 shares in that one contract.
Yeah.
So by purchasing that one option, you effectively control 100 shares and have the right to either buy or sell those 100 shares depending on the type of option at the specified strike price.
Yep. Yeah, thanks for clearing that up, actually. Yeah, so options are usually sold in times 100 contract multipliers. So let's say that, you got 100, like one call, right? A right to buy of 100 shares of X stock, but you didn't have the money to cover it, then you can't exercise it. Now you just own the premium insurance policy on it. You own the derivative on it, but you don't own the shares. You can own the shares if you have enough cash or you have margin to buy the shares. Now, yeah, you can also buy call options. That's another strategy to actually hedge your bets. This is the right to buy, like I mentioned earlier. You could buy call options during a recession if you anticipate a quick recovery. This way, you'd be able to lock in a stock at a discount if it rallied beyond the strike of your call. So you might be wondering, if you think a stock is going to go up, why don't you just buy the shares? Well, like we said, the scenario here is that it's a recession, so it could continue to go down. And if you bought shares, you might be losing money. So shares expose you to downside, whereas options, you don't lose anything other than the premium that you paid. That's what insurance is, right? It's just in case X happens. You want to have the flexibility to be able to exercise it. So you eliminate the possible downside risk if you buy a call option, because now you're not exposed to any more losses than the premium you paid, and you're not exposed to the downside of market risk. Now, let's say the stock goes beyond your strike price, then you buy it at a discount and you win. Let's say the stock continues to go down, then you don't lose as much as you would have. So it's sort of a win-win situation there. All you lost was the premium on that insurance contract. So you might be wondering, now you have the insurance understanding of options, but why do they exist? Well, according to Kenneth Arrow, a mathematical economist, all risk must be traded in order to reduce macroeconomic risk. So that seems a little counterintuitive, right? But what he's basically saying here is that risks have to be traded and available to investors in order to help markets be efficient, basically. So in a sense, a creation of more risk ensures you against economic inefficiency. And you want to hedge against risk by using more risk. And if you have multiple kinds of risks that you can take on, then you're a lot more comfortable as an investor. So the textbook justification is provided by Stephen Ross, a financial economist at MIT and Yale, who was also a physics major from Caltech. The justification is actually really simple. By dissecting the risk of the market into varying strike prices and expiration dates, you've essentially given your many different investors many different types of risk burdens that they can take on, and this will round out the market based on your individual risk preferences. So just one way to think about it is, all right, let's imagine you have, thousands, millions of investors who have, all sorts of different risk preferences, right? You want to make sure that all of those are catered to. So that's why options exist for different strike prices, different dates. And yeah, because let's say that you want a lot more exposure to a stock. Well, options provide non-linear returns, right? Because they're derivatives. So Mahesh will explain how these non-linear returns work. Mahesh, if you want to explain why, let's say a more risk-averse investor would want to use a certain type of option versus why an investor who's open to risk would want to use another type of option, you can discuss the Greeks right here.
Sure. Okay. So when it comes to risk, I could say before we even delve into Greeks, just general rule of thumb is that when you purchase an option, the most risk that you're being exposed to is just the premium that you paid for. And so if you're looking for low risk, I guess if your premium is low, you could go ahead and purchase an option, and in the absolute worst case scenario, the premium would go to zero and you would lose your entire bet. But some cases, when you're selling an option, you're legally obliged to sell shares at a certain strike price to the person who bought your contract. And so let's say you sold a call and the stock continues to go down. You're responsible for providing shares to the person who purchased your option at the strike price and then selling it to them, purchasing at the market price and selling it to them at the strike price. So if it just keeps going down, you're losing more and more money. And in the worst case scenario, you could potentially just lose 100 times of the share price per stock, which is very significant. And that's when strategies like spreads come into play, which Harish will be discussing later. But just as a general rule of thumb, if you're selling options, they're a lot riskier if you leave them uncovered. There is a little bit of risk that's being taken away because of theta decay, which I'll go into, but they're essentially uncovered, meaning that you're exposed to infinite losses. Not infinite, just very large losses compared to the upside. All right, so
Right.
without further ado, yeah, you got anything to say? Or
Yeah. So I wanted to add on just to what Mahesh was saying. Like I said, the reason that options are available in the first place is because investors want different types of risk, right? And that's why I wanted to delve into delta and other sorts of indicators that can tell you how risky an option is. So
Right.
options actually have these metrics that discuss like how much risk you would be essentially taking on, and that's what Mahesh was going to discuss after I'm finished explaining the basics. So so like I was saying, the reason that options exist in the first place is because people want different types of risk preferences, and Mahesh will explain how you can measure those if you're interested in options. But by creating multiple types of risk for one asset, you create this really big market, right? And the bigger that the market is, the less inefficient it is. So if you believe in efficient markets, you would believe that there would be options out there because now you have a broader reach. So yeah, like I said earlier, everyone uses options to hedge against downside and protect your portfolio. You're likely invested in a mutual fund that uses options. So do you believe that ordinary investors should use options to hedge?
Um,
I mean, yeah, sorry, I'll
yeah.
go ahead first, but it depends on the kind of strategy. So if you're a beginner investor, you could go ahead and do what's called a covered call. So you could purchase X number of shares and then sell X over 100 number of calls to hedge against them. In that case, you're essentially exposing yourself to less risk, because if the price of the stock were to decrease, then the calls that you sold would decrease in premium, and you could buy them back for cheaper. So that nets you a profit, which hedges against the losses that come from your shares. So that's just one example, right? There are others, and of course, you could expose yourself to massive amounts of risk through options. But if you wanted to, you could also decrease your risk. So it really depends on the strategy. I think if you're an investor, yeah, you can benefit from options totally.
Right. Yeah, and I think covered puts are also a good idea, right? Let's say you believe that a stock is going to keep on going up. Well, then you could easily just sell a put, right? And that would also be one way to hedge against risk of the market, because by selling a cash covered put, you're sort of able to take a neutral bullish position, right? Rather
Yeah.
than going full on and owning the share.
Yeah, even if the stock weren't to move at all, you would still profit from a theta decay.
Yeah, exactly. See, options actually tend to lose value, right, as they go towards the expiration price, and this is because, let's say, the stock just it doesn't move, right? Well, then all of the insurance policy, the insurance doesn't become as necessary, right? The stock's volatility goes down, so now people don't need insurance. Well, in 2008, right? Like, just imagine why in a recession would put options go up? Well, people want to be able to sell, right? That's what they want because it's volatile. So during volatile times, it could be a really great time to take advantage of options contracts and the premiums and possibly sell options, buy options. And that's why, maybe especially a few months ago, it would have been a better time to understand options. But now that they're a lot more stable, there is still uncertainty that you could play off of and probably factor into your portfolio to hedge against the possible downside of a secondary recession that could happen. But yeah, I think, Harish, Raghav, what do you guys think then? Like, should ordinary investors still be, using
I
options to
mean,
hedge?
I think options would be pretty useful to any type of investor. You guys talk about covered calls, but I also think you could just buy just the calls and the puts, but as a hedge rather than as an investing strategy. Because, no one is exactly 100% accurate in predicting the market. No one could be. If you would, like Rudra just said multiple times before, you'd be like employed for like $1 million at the best hedge funds. But no one can predict the stock market exactly. It's good to hedge against the market, and that's where stock derivatives come in, options, because they react to stock price movements much more drastically than stocks. So let's suppose the stock price does go down, and you thought you were bullish on the stock, it would provide a nice hedge in that scenario.
I might think this might sound a bit immature, but if you want to earn, like, obviously money doesn't come quick in the stock market. You have to wait for a bit. But in that, options are a good way to earn money, in the sense that instead of exercising the option, let's say you have a call option, right, and the price of the stock is continuously going up, then the premium that you bought it for, that will continuously keep going up. So then you could sell the option contract at a higher price and earn it that way. So you don't really have to exercise the shares, and you can still earn a profit instead of um, having the contract just expire without using it.
Well, not having it expire, because then that would be
Yeah.
worthless. But yeah, you could sell it. Yeah, you can sell options as well, and that's called options trading, because you're buying and selling constantly. You're not using it as an investment strategy. Um, and yeah, options trading. I guess we could discuss that a little bit as well. It can be extremely risky because you require margin for some certain types of options contracts. Because like Mahesh mentioned earlier, right, that legally you have to be able to cover anything that you're offering to sell, right? So if you sell a call, and you don't cover it with your shares, then that could lead you into like trouble, right? Then you need to have margin, to cover for that, because again, a call is a right to buy. You're selling a right to buy. Let's say that a share goes way beyond the call's price, then you have to cover that, right? So if you sell calls on X and X goes beyond that, obviously the person who bought the call will want to exercise it, and you might not be in a great situation if you don't understand the margin completely. So yeah, the lack of understanding in options can be a big issue, which is why I think it's better off that we don't let ordinary investors just trade them, but rather use them as a way to enhance their portfolio. But yeah, that's if you understand trading, then you could trade all sorts of things. Um, but can options lead to a slippery slope, right? And I'll specify this question a little bit more. Um, Options are insurance, right? So the thing with insurance is, let's say that you're worried about your insurance, so then you go to insure your insurance. Does that lead to a slippery slope of too much option and too much insurance and uncertainty within your portfolio?
As long as you're using options for their intended purpose, which is to hedge against the stocks and commodities that
Right.
you bought, I don't really see a problem, but at least for small investors. But when you get into trading options, when you are really trying to use it as a hedge, that's where it becomes a problem, because then you don't know what you're doing, and you're kind of not doing what you intended to do.
Yeah, exactly. So you try to insure your shares, but then you insure the insurance, right? And then you just go down the line of buying more and more options to insure your options. So that could probably confuse a lot of investors because of the non-linearity of options. They're much harder to predict than shares. Shares are already hard to predict. Now imagine how hard a derivative would be to predict, right? Um,
Yeah, I mean,
so yeah, the slippery slope of options, it's definitely I think a concern.
see,
But as long as you're a little bit conservative with it, you should
see,
have it.
option contracts can be expensive as well. Like, I mean, not as expensive as actually buying 100 shares of the stock, but they can still be like somewhat expensive for a beginner investor. So if you keep like trying to insure your option, and the market goes in a completely other direction than what you like hoped for it to go, then you have a tremendous loss, because all your insurance that was worthless basically.
Yeah, right. And that's what insurance is, right? That's why you shouldn't rely only on insurance. You should always have cash on hand or have easily liquefied assets on hand. But yeah, Mahesh, I think this would be a good time for you to discuss like options risk and how to measure it.
Sure. All right. So Rubij was talking about how options allow people to diversify the risk by providing so many different um, strike prices and expiration dates in the options chain. And so with all those different prices and dates, you get you can boil the kind of attributes about each option into 4 different metrics. And so these 4 metrics are called Greeks. So one of the Greeks is called delta, and delta describes that for a $1 change in the underlying stock price, how much the premium will change for that given option. And so, for example, with a delta of 0.3, if the underlying stock's price increases by $2, then the premium for each share will increase by 6, or the total contract's premium will increase by $60 because that's just 2 times the delta, which is 0.3. And so the lower the delta, the lower the reaction to the option's premium will be to the underlying stock. But the higher the delta, the more extreme the change in the option's premium will be. And so usually time and delta have a positive relationship. And what I mean by that is that as time goes on, delta tends to increase because you have less and less time for that option to move towards a strike price. And so now you're getting rewarded more and more for any sort of move towards the stock price, and the delta goes up. And generally, if an option is long dated and there is a very long time until expiration, we generally call these leaps. If an option is over like 1 year long, they're called a leap. I think it's long-term expiration. I don't know the exact acronym, but yeah. If you purchase these kinds of options, the delta will generally be lower, and it'll react less to the underlying stock's movement since there's a lot of time for it to move, and anything could happen in that time. So yeah, that's delta. That's one of the 4 metrics. Then we got theta. So theta is probably the most important of the Greeks. Theta actually describes the time decay factor in an option, which describes how much premium gets removed from the option per share each trading day. So for example, with a theta of negative 0.01, the next day that option's premium will have decreased by 0.01, regardless of the movement of the stock's underlying price. And so that isn't to say that the contract's value could go up, but any gains would be reduced by that amount theta each day. And so the reason why theta exists is because options premiums have time factored into them, which I talked about during delta, right? So if there's more time for the underlying stock to move, that option has a higher value since there's more time for the underlying stock to potentially reach that strike price. And so every day approaching expiration, there will be less and less time for that option to reach a strike price, which decays some of its value since now it has less and less time to reach there and it has to get there faster. And so that factor of decay is being represented by theta. An interesting thing to note is that theta decay is exponential, which means at first an option's theta is relatively low, but as expiration approaches, theta increases exponentially. And for this reason, it's similar to how delta increases a lot leading up to expiration. And so for this reason, longer dated options, again, have low theta, and options that are near expiration have very high theta. And so as an investor, theta decay is something to watch out for, especially when purchasing these kinds of leap options. Since when purchasing these options, you get a little bit of premium eaten away every single day after holding it. So if you're holding it for a very long time and the stock isn't moving at all, you're going to lose a lot of your money to theta decay. But on the flip side, if you're selling an option, theta decay actually benefits you since the premium's getting cheaper and cheaper to buy back approaching expiration. And another one of these Greeks is called gamma. And so gamma is closely related to delta. It's just how much delta changes each day. And so I mentioned when talking about delta that it typically increases leading up to expiration. And the reason for that is gamma. And so since there is less time for an option to move approaching expiration, there will be a higher risk reward for any move in the underlying stock as the move counts more and more with less and less time till expiration. So gamma increases delta every trading day, putting that factor that I mentioned into effect. And the final one of these 4 metrics is called vega. And so vega is probably the least important, but it describes for a 1% change in implied volatility, which is commonly referred to as IV. It describes for a 1% change in IV for how much the option's premium would change. So for example, with a vega of 0.2, for a 2% increase in IV, the option's premium per share will increase by 0.4, making the value of the entire contract increase by $40 since you own 100 shares in the contract. And so this is because with a higher volatility, there's more of a chance for that option to reach the strike price, and there is a higher movement in the underlying stock's price. Typically for hype stocks or popular stocks like Zoom or Tesla, Vega is higher, with Vega being lower for lesser known stocks. Accordingly, implied volatility is higher for these stocks just because they're traded more often and you get more benefit for, I guess, hype stocks have, especially biotech stocks and things like that, they have a very high volatility. And so Vega is pretty high. So just a couple of questions. I just discussed 4 of the key metrics. You guys can go in depth, but whenever you purchase an option, you should be looking at these 4 things. So theta, delta, gamma, and vega. And they greatly influence the premiums and kind of the outcome you can look for when purchasing an option. And so when you look for an option, what do you guys prefer optimally for the Greek values to be? What are the most desirable values?
Well, for me, I think the values, they're kind of subjective. So, for example, for GE, the delta is very high, right? Because GE, for it to move $1 would be a lot because it's $6.50 right now. So I think Vega is probably like a lot more important because it doesn't, rely on the price of the stock, which is kind of arbitrary. But also for me, I'd look at implied volatility, which is really important because if you want to be, very risk averse, right? That's probably what you really want to look at. You want lower implied volatility on any options you're buying and higher implied volatility on any options that you're selling. Because you always want to sell when volatility is high, right? That's when insurance is most profitable. And you want to buy when it's low because that's when insurance is the cheapest.
Yeah. I think it depends a lot on what you're trying to do with options. Let's say, for example, you're trying to hedge, okay? You might focus on delta rather than any of the other factors because you want to make sure that your hedge is strong enough to protect you from financial struggle or just financial harm when your stock acts unexpectedly. So in that case scenario, you would want to use delta. Traders, you could probably look at something else. You could probably look at volatility. You could look at Vega, because traders literally operate or they make a profit based on Vega. High Vega means you can quickly buy, you can quickly sell, and make a decent profit. So it all depends on what you're trying to do.
Personally, I would look at theta more because it deals with the option premium price. Like personally, when I trade options, I wouldn't really I've never actually exercised the call, so or exercised the put. So I would rather look at theta because it's a good factor in telling me how much profit or how much decay or how much loss I'm going to take from selling an option contract for the premium.
Yeah. So I think we already discussed this a bit, but my second question is how can different values in stock like consumer sentiment, beta, implied volatility, and others affect these Greek values?
Yeah, so implied volatility, I think it probably has like a pretty big effect on Vega, right? So I think on any price based indicators, implied volatility would have a good amount of an effect. But I don't know. I guess I'm not really an options scientist or like a financial engineering type, so I'm not 100% sure like how exactly or precisely it would affect it. But yeah, I think consumer sentiment, it would probably drive in a lot of volume, and that might increase IV, which in turn could increase the delta, and yeah, I don't know. I mean, to be honest, I think to research how Greeks can be affected, it's a really big equation to understand. So it takes a while to have a really firm understanding of it. But as long as you know what those numbers are and you know how to use them, you could probably be good.
Yeah, options are definitely a very complicated matter. There's actually an entire equation just to derive the actual value of an option and kind of predict it. It's called the Black-Scholes model. You guys can look it up. Actually, if you go to optionsprofitcalculator.com, they have a Black-Scholes model kind of built out, and you can use it to see how your options premium would kind of move over time if the stock price were to go to a certain value. And so you have to kind of factor all these things in when you want to value a derivative as complex as options. Yeah. Just wanted to bring that up.
The Black-Scholes model is actually like one of the most important equation pricing models that exist in modern finance. The people who the economists who invented it, they're probably like one of. I mean, it in theory it works really well, and they're really smart for thinking it out. But to be honest, it's just a concept to be learned rather than something that you could apply to your practice, because the problem is it's for European options is the first thing, and the second thing is like it just works only in theory for the most part. So it is a good model to understand if you're like a finance type and you actually want to understand it at its core. But yeah, I don't know how helpful it would be to an average investor.
I mean, yeah, it is purely theoretical, but it tends to predict the actual graph of options decently. So I think it would be something to note, at least when trying to going into a contract, to kind of see how your profit and loss would look. Or at least for a beginner trying to get into options, it's very useful to just know it to, I guess, get the basics down and see how your option would react to different things. But yeah, it's more of a theoretical than an applied.
All right, so Harish, do you want to talk about your?
Yep. So I'll be talking about spreads. So spreads are kind of a way where you can limit your maximum loss potential in buying options by buying and selling options. So spreads are split into two big parts. We have credit spreads and debit spreads. Credit spread involves selling or writing a high premium option and simultaneously buying a lower premium option. So the premium received from the written option is greater than the premium paid for the long option, resulting in a premium credited to the trader or investor's account when the position is opened. So when traders and investors use a credit spread strategy, the maximum profit they receive is the net premium. The credit spread results in profit when the option spreads narrow. So for example, you can implement a credit spread strategy by writing one March call option with a strike price of $100 for $10, while also buying one March call option at $120 for $5. Since the usual multiplier on any equity option is 100, the net premium received is 500 for this trade. You also have to have 2,000 as collateral in your account for the scenario where you have to execute the option. We talked about this before. And with typically you could also use margin. Here we're just talking about 2,000 in collateral in your account. So this is the difference. The 2,000 is calculated as the difference between the strike price, $20, multiplied by the 100 stocks in the contract, which gives us 2,000. Furthermore, you'll profit if the difference in the premium of the price narrows. If you're bearish on a stock, you would set up a call credit spread on the stock. And if you're bullish, you would set up a put credit spread on that stock. With the debit spread, on the other hand, you buy an option with a higher premium and simultaneously sell an option with a lower premium. This time the premium paid for the long option of the spread is more than the premium received from the written option. Unlike a credit spread, a debit spread results in a premium debited or paid from your account when the position is opened. For example, you could buy one March put option with a strike price of $120 for $10, and simultaneously sell one March put option with a strike price of $100 for $5. Therefore, you paid $500 for the trade. You can also use iron condors when you believe the price of a stock will remain the same. With an iron condor, you would get both a credit spread and you get a put credit spread and a call credit spread. The difference between the premiums is the profit credited in the scenario, but this decreases as the price of the stock varies away from the middle of the two spreads. But I have some questions for you guys. So, would you rather use debit spreads or credit spreads, and why?
Well, okay, so if I was more risk averse, I would probably go with credit spreads. But the problem is many brokerages, like they have a silly policy where you usually require margin to go with credit spreads. So unless you have like Robinhood, it's I think really hard to access credit spreads without having margin. But let's say that you do have margin enabled, which is not always a bad thing. Like we said earlier, leverage can be used for a lot of positives, and usually it can amplify your gains. But let's say you're a responsible margin user, then I would say credit spreads are useful, and any other strategies that require where you are credited, I think they usually end up being more risk averse than anywhere you're debited.
It's a very good answer. So, like Rudwitz said, debit spreads are more like, I would say, for beginner investors, where as you get experienced and learn to use a margin effectively, with the lower risk, you can start going into credit spreads. Anyone
Yeah.
else have any answers to this?
And also,
So
let's
when it
say,
comes to
yeah, sorry, I'll just wrap this thought up really quickly. Let's just say that you're kind of you have limited capital, right? Then if you want to buy an option and you're not, exercising it because you can't really exercise a debit spread, because you're buying and selling calls, right? Or buying and selling puts. So you can't really exercise them. But it would be a good sort of trading strategy if, let's say, you don't have enough money to afford like calls on Tesla. Then maybe a call debit spread would be cheaper. So that would be one place where a debit spread would be useful. But in my opinion, for most investors, it's actually not a good strategy because you can't exercise it, and it's not really an insurance. It's a form of trading.
Yeah. I think if you're an options trader and you're looking to decrease your premium because you want to get into some stock or asset that has a very high kind of barrier to entry. So, for example, if I was looking to trade Tesla and I don't actually have enough to trade Tesla, or if I wanted to trade options and I don't have the premium, I could go with the call debit spread. And that's usually for options trading scenarios. For a credit spread, when it comes to me personally, I think they're very useful in earnings plays. Although they're not generally advised to hold through earnings, if you're really confident about something, which I wouldn't advise, but if you are, what you often have to watch out for is something called IV crush, which is where after earnings, the premium of your options drops drastically because leading up to earnings, there's a lot of volatility building up as no one knows where the stock's going to go before earnings. But after earnings finishes, that binary event kind of collapses and all of the volatility associated with it goes away. And so with that, because of Vega, your stock, the premium of the contracts decrease a lot. And so you could actually take benefit from that if you're selling a contract. And so that's where I could use credit spreads potentially to benefit from that decrease in premium. But yeah.
Yeah. So my second question is, what industries would you get put credit spreads for, or put spreads for right now, and which industries would you get call spreads for? Based
think
on
that's another
what
way.
you would use the spreads for.
I mean, I think the general question surrounding that is just which industries do you think are you bullish on and which are you bearish on, right?
Sure, but also as in, you have a lot of different strategies for spreads that can be used for trading. Depends on whether you want to get a debit spread, credit spread.
Mm.
But also, I guess also kind of what you're bullish on, what you're bearish on right now.
I could use spreads to kind of hedge against any shares I own, kind of as like, I guess, a broke man's covered call. So like if I don't actually own enough shares, I could do something like a spread to reduce my risk, not to the extent that selling a certain contract would, but I could do something like a credit spread, and that wouldn't have the full effect, but it would to some extent.
Yeah, I'm just on the same boat as Mahesh on this. I mean, yeah, I don't know. It seems like kind of uh it doesn't seem like a proper attempt at hedging. So I don't
Yeah,
know if I would ever use them in my
I think
portfolio. Yeah.
the main types of people who would use spreads are kind of options traders looking to lower the risk or lower the downside risk, especially with credit spreads.
Yeah.
So yeah,
I
if
mean,
you're
it's
yeah,
yeah, like Mahesh said, it's a perfect way for, if you don't have the sort of the buying power, probably easier for you to
yeah,
use spread.
Okay,
it's
then
easier.
let's go on to Raghav's part, and
All right,
we'll be talking about
so
covered
I'll be
calls.
discussing two very effective strategies in the world of options trading. One is called a covered call and one is called a naked call. All right. So a covered call is basically when you own the shares of an underlying security. So let's say I own 100 of X shares. So USDO, right? I own 100 USDO shares. So I can write um a call option on those shares, decide the contract, and decide the price and everything, and then sell the contract to a buyer. So the goal of a call option owner or the call option seller is for the contract to expire worthless. So like right like so you would get a profit on the shares you bought, but the share market price would still remain below the share strike price. So you would earn a profit on what do you would earn a profit on your shares, and you earn money when you sold the contract. Now there's a downside to this in the sense that if the strike price is stays lower than the market price, uh, then the buyer of the call option can decide to exercise, and then you're gonna have to sell the shares to him, which is not ideal, but you're still making some profit, right? Because if the strike price is higher than the price you bought it at, you're still making some profit, but it's not a huge profit. Now, let's say you sold the option contract, and the market price of the shares went down, uh, and you're at a loss on the shares. The market price of the shares went down from when you bought it. So the option owner is obviously not going to exercise, and also the shares you bought to cover the option, they're they're at a loss. So that's basically useless. So I mean, you made a quick buck selling the premium option premium, but you're still at an overall loss. Now, there's a second strategy you can use. It's called a naked call. Correct. A naked call is basically the opposite of the covered call. You don't have the shares to cover for your option. So you basically write the option, but you don't have the shares. So the goal of a naked call is for the option to also expire worthless, meaning the market price stays lower than the strike. This will give a profit to the seller of the call option. In a naked call, there's limited upside, unlimited risk, because there's no limit to how much a security's market price can rise above the strike price. The buyer of the option can demand to exercise the call, and then you're basically um, that's it for you. Then the seller can then the seller of the option will have to go out and buy the shares for the market price, depending on how much the market price is higher than the strike price. That's how much his loss will be, and then sell it at the strike price. So you're basically buying it for a higher price and then selling low. That'll result in tremendous loss. So I recommend only highly experienced investors should undertake this covered call or naked call strategy, because again, limited upside, unlimited risk, but the upside is still pretty big in this strategy. A covered call is a bit more safe than a naked call, because naked call, obviously, if the buyer decides to exercise, then you're going to have to go back and buy shares and then sell them for a loss. But um, yeah, so I got a question. Let's see. So for beginner investors, do you guys recommend selling the contracts or exercising them?
I mean, with a beginner, I don't think they could exercise contracts with the amount of money they'd have in their account.
I mean, you could probably exercise some forward calls.
Yeah.
You
I mean,
know,
I look
it
at like the
depends.
Some
stocks,
kind of
like
penny stock.
like $5.
Yeah, it depends on how big
maybe.
your account is, really, and it depends on what your goal is. So it's kind of hard to ask that question and get a blanket response. But I mean, I guess if you're a trader, you'd be selling all the time, right? And if you are a conservative investor, you're either expecting to exercise or sell options, right?
Um,
Yeah.
yeah, that's a good answer. So also, I mean, this might be like this might be what do you call it? Personal, like personality geared answer, but do you guys view calls or puts more? Uh, Sorry, let me rephrase that. What do you guys view as more profitable, calls or puts?
Well, okay, that
I
is
mean,
a good question, and
yeah.
let me explain why. Usually, the right to sell is a lot more expensive, so the premiums on puts are always higher. I don't know if if you have ever gazed at options, you'll notice that puts are always more expensive, and that's because I guess people are always they're always willing to sell, right? You have to convince a lot of people if they want to buy something, but the premiums on puts are always higher, so yeah, I'd say like puts are better to sell because the premiums are higher, right? So and then in order to buy, since call options have lower premium, then I mean I think that they're actually better to buy. So if you ever wanted to do a debit spread, then or just buy a call, then I'd say or buy an option, then I'd say buy a call. But if you were to get credit for anything, then I would say a put is better, and hopefully, a put that doesn't give you too much risk.
Yeah, and that's not always the case. I mean, of course, if a stock has been going up for a long time, the call premiums are going to be a lot higher. But I guess as a baseline, I think if you charted the options chains of like every stock on the market, I guess on average the put premiums would be higher.
Yeah. Well, I don't mean in like just the sense of how much they cost, but I mean like relative, obviously, right? Like not just the raw figure.
Yeah, yeah.
But yeah, relatively, when you get into the lower ranges, and I mean like far out of the money, then puts are still more expensive. So the premiums on puts that are far out of the money to sell are actually better than far out of the money calls. So that's why it'd be better to sell put.
That concludes today's episode. In the next episode, we'll be discussing different portfolio management strategies and the math behind them. Stay tuned to find out more.